Question: how do you manage giving points back throughout the day? Meaning the first handful of trades I take are green and I average about a half an ATR. ATR meaning average true range. But as the day progresses, I find myself on the losing end of the spectrum or breaking even. I have a pretty good gauge of market conditions and I follow RAM to the best of my ability. How can this hitch be overcome? So in a lot of cases, what's going on, if you're doing well in the morning and giving it all back and then some in the afternoon, a lot of cases what's happening is the volatility is opening up in the morning and you're trading nice continuation trades in the morning. And then as the day goes on, you're losing context. And then by bar 53 into the close on bar 78, that's the close of the New York session here on the 5-minute chart, you're giving it all back. Honestly, like 8 times out of 10, that's what's happening to traders is they're doing well when volatility is higher. And then as soon as volatility starts to tank, ATR we saw kind of tank throughout the rest of the day today. And we entered a trading range for a huge chunk of the afternoon. Couple of hours. It was just a trading range, no bigger than 20, 30 points. That kills ATR and makes edge quite a bit harder to come by. And if you're trading in there, that right there, if you were making all your money in the morning on continuation setups, unless you really, really change your style to more of a range strategy, in the afternoon, which a lot of traders don't, that's the problem. They're betting on breakouts in a range market and they end up giving it all back because volatility has collapsed in the afternoon and we've entered a trading range. Okay. As ATR comes down and the market is clearly entering a trading range, you have a couple of options. You can trade the range. Okay, but you have to recognize that context. And now you're buying bear closes in the lower third of the developed trading range, or you're selling bull closes in the upper third of the developed trading range. Okay, risking something that makes sense based on how wide the trading range is, and the tighter the trading range gets in terms of points, the tougher it gets to trade. Okay, wider trading ranges, in my experience, are a bit easier to make money in than tight trading ranges because you have more points back to the midpoint of the range when things tend to slow down. Think of a rubber band getting pulled hard around the edges, and then you kind of let it go and it goes limp. That's kind of the market back in the middle of the trading range. When you have more room back to the middle, that's when ranges tend to be a bit, quote unquote, easier to trade. When they get a little tighter, like, today, 20, 30 points approximately, as far as a range, when the market was a bit more volatile earlier, that gets hard. And traders start giving back points. Okay, so, if you're going to sit and trade, you have to adjust and you have to start trading with a range mentality and absolutely stop betting on breakouts or you will give everything back and then some. You cannot bet on breakouts in a trading range. At least you shouldn't. Most traders should not. If you're going to do so, you have to understand the probability of breaking out of that trading range on any given attempt is going to be something like 20%. So you better have a damn good reward to risk to make that math work. Otherwise, the math is not going to work. Okay, so you got to adjust to a trading range mentality. Again, selling bull closes in the upper third of the trading range, buying bear closes in the lower third of the trading range. All right, and don't give it too much room. Though in most cases, about 80% of the time, it will return back to the trading range if it attempts to break out. But if it does break out, you don't want to be giving it, 95 points when you expect to make 8 when you're coming back to the middle of the trading range. So the tighter the trading range is, the less likely I am to trade it. That is honestly usually what's going on, especially on a day like today where we get the market opening up early and then tightening down hard and ATR collapses later in the day. In this kind of thing, you got to be careful. For a lot of, especially newer, even intermediate traders, best case scenario, if you're green on the day from this and you're seeing this continue for 45 minutes, an hour, and it's getting later in the afternoon, walk away, come back tomorrow. Listen, the most surefire way to get to profitability and stay there is not just getting a little bit better. I'm telling you guys, this is far more about removal and protection than a lot of traders seem to realize. Now, in the early years, in the early months, in the early days of your trading, I get it. This is a concept that I think is a little bit difficult to grasp. It doesn't necessarily align with the hype train of what we all kind of think trading is in the early days. Now, trading can be every bit of that and then some. Okay, but it's going to end up looking a little bit different. There's going to be a little bit more patience required, a little bit more discipline required. But on the flip side of that, if you're able to do those things, it can take you far further than you would have thought originally. Okay, so it's a give and take. Obviously, in my opinion, ends up being a net benefit, stripping out a little bit of what you originally think trading is going to look like this high adrenaline, we're always doing something kind of thing. Whereas it's not. But again, I'll repeat myself, it can take you far further than you think if you develop the necessary, I'll say, skill set, like the discipline, the patience, and the obsession with protecting your edge. So, a lot of traders, what they think early on, if they're losing money, they think that they just have to get a little better. Okay, they have to get a little better at identifying their setups. Now, that may be true, but more often than not, what the case really is that most people who are following a particular methodology, those of you guys that are trading RAM and you have a reasonable understanding, you've consumed a lot of the content here in the Tomb, you've done your studying, you're doing your personal after-market close kind of 2-minute chart reviews, you're holding yourself accountable. Everybody knows kind of what they should be doing. They need to be reading context and then applying setups to the best of their ability to that context. Context always comes first. Everyone kind of knows that. So how do you just get a little bit better? How is that going to fix the problem if a trader is hemorrhaging money? The problem isn't that they need to get a little bit better. The problem is that they are suffocating the good trades with 3 times as many garbage trades, right? That tends to be the case. Most traders, now not everybody, in the early days, maybe a lot of your trades are kind of random, but most reasonably developed traders who are not profitable are doing some logical things, assuming they're following a methodology. They have a motive for taking the trades that end up being their better trades on average. The problem is they're taking a pillow and smothering those good trades by taking little stuff all through this. That's a huge, tremendous problem. Okay, those good trades are never going to have an opportunity to shine if you're smothering them. Now, this is not an overtrading conversation, at least not directly. It kind of turns into one. You guys know, I know that overtrading only exists if you're stepping outside of your edge to take more trades. If you take theoretically 50 trades in one day and they all align with your methodology well, that is not overtrading. That's simply taking your edge, expanding the sample size. Now, of course, that's an extreme example, okay? But just to get my point across, that's the truth. Overtrading is only real. It only exists if you're stepping outside of your edge to take more trades, which is what most people are doing. So don't worry about the number, guys. What you need to worry about is just being disciplined and patient enough to let the good trades shine. Let me make a comparison here. If somebody's goal is to lose weight, they can eat the meals that align with their goals. They can eat all the chicken breast and asparagus, whatever, that they can. Not that they can. That's on the plan, right? They can do that. Let's say they're on, 3-4 meals a day, whatever. They're looking to just lose weight. That's their only goal. And they eat those meals. Well, guess what? The goal is completely screwed if they're eating McDonald's also for breakfast, lunch, and dinner. They're blowing out the calorie count, correct? They're still eating the chicken breast and asparagus, but they're smothering it with quote-unquote bad as far as how it aligns with their goal. They're smothering it with way more calories, even though they are eating the good, okay? So when you're taking good trades, you need to think about this the same way. In order for it to do what's necessary, what you're looking for it to do for you, you have to stop smothering it. And this is actually a pretty spot-on comparison because we're talking about kind of the slow burn, kind of quote-unquote traditionally seen as boring foods, right? Like, okay, I'm going to eat some chicken breast and asparagus and it's just going to be okay and I'm going to move on with my life. Versus the dopamine-fueled, high-octane, good stuff. We love it, man, right? But it doesn't align with the goal right now, right? It's the same thing in trading, kind of the slow burn, the stuff that requires patience. You got to kind of wait around for it sometimes, not always. Sometimes it's good trade after good trade after good trade. But a lot of times, you're sitting through garbage like this, waiting for something to present itself. And through this, what a lot of people do is they start going after that high octane, high dopamine driven stuff. Like, they'll say, I'm a good trader. I can micro scout my way through this thing. It's like, well, I mean, look, if the options are do nothing or take negative expected value trades, what are you doing? If positive expected value isn't on the table for you in the current market environment because it's a single bar sideways trading range, it's the equivalent of, I made this comparison on stream. It's the equivalent of owning a coffee shop and you have two options. You can either do nothing or you can sell a customer a cup of coffee that costs you, let's say, $9 to make. It's a fancy cup, man. And you can sell it to them for $3, for example. Okay, so you have two options here. You can either do nothing or you can sell a cup of coffee at a loss. What are you going to do? Well, you're going to do nothing if you care at all about the business. That is particular market environments when you don't have positive expected value. It's just not in the cards right now. It's not on the table. It's a toss-up. The probability is way too close to 50-50 to be comfortable actually putting on risk. Okay, because remember, we got commissions, fees. That flips it to negative expected value pretty quick. Even if you think, maybe I have a tiny little bit of edge here. It's like, well, do you have enough to cover those things predictably and still have it work out with a reasonable sample size rather than a sample size of 100,000 trades? Right? The less edge you have, the bigger the sample size it takes to predictably produce a profit, right? You got to protect your edge at all costs. Okay, if that means sitting for hours through a trading range when, positive expected value just isn't on the table for you, then that's what you're doing. You're protecting the good stuff to give it an opportunity to float, to shine. On the flip side, people forget about this next part of discipline, right? If you get 6 trades in a row because the market enters some huge, tremendous trend, and it's ram trade after ram trade after ram trade, and you're looking at it, you're like, oh my goodness, I would classify all these as like A- and up. Man, as long as all the boxes are checked, the risk management is logical, the reward to risk is logical, the setup is logical, the probability is logical. You gotta hit it. You gotta hit it. A lot of people get scared. They'll take a trade and they're green, and all of a sudden an A+ setup presents itself and they're terrified. They're like, I'm not gonna put it on. I don't want to give back my day, right? Well, I mean, listen, I get it. I understand the psychology of that. We are human. It doesn't feel good to be green and then give it back. But you're thinking about this way too zoomed in. You need to zoom out a little bit. Forget about these 2 trades and look at each individual trade as an individual event, as part of a big sample size of trades. And you could jumble them all together in different orders And as long as you have a statistical edge, if the sample size is large enough, you're going to end up with a net positive result when you do all the adding together. Again, assuming you have that statistical edge, right? And you're not drowning it with bad trades. And you're remaining disciplined and patient. Doing logical things, right, according to the methodology. You do all these things, and you have that statistical edge. Now your job is just to expand that sample size. If you're drowning it with bad stuff, you're going to throw it all together, jumble it all up, do the math, predictable loss. Okay, like is the case for most traders, because they're either not doing logical things, they have no repeatable methodology as far as decision making, right? And they're also drowning the good with the bad. Okay, you got to think I get it, it's hard, okay? But try not to think about, oh man, this next trade, I don't want to wipe out that last trade. It's like, well, what if you took these trades 35 trades apart? Same difference in the end, right? You could jumble all these together. It's just another tick in the box of the bigger sample size of trades. Okay, if the setup is there and all the boxes are checked, and you know it, you got to put it on. That's part of being disciplined. The same way that sitting through, 90 minutes of single bar garbage sideways trading range is also discipline. A lot of traders, they think that in order to get profitable and stay profitable, they just get to keep doing what they're doing. They just got to get a little bit better. No, you have to increase the gap between the bad and the good, which means you're taking more of the good trades with less fear, and you're taking far less, if not none, of the bad stuff and giving the good the opportunity that it needs to shine. All right, hope that helps. There's a really common occurrence after a trend in either direction that I want to kind of drill into your head, because this really does happen a lot, and I think it'll keep you out of some bad trades. So, right, what I should say is some trades with perhaps a negative expected value, okay? So, look on this chart. This is a 5-minute NQ chart from bar 9 up through bar 19. Now, it'd be fair to call that a trend, right? It's not necessarily a big, giant, all-day trend or a multi-day trend or something like that, but that's pretty aggressive move, all bull bodies. We can call that a trend, right? Now, when you get to bar 19, you got a big wick on 19. Okay, so let's wait for 20, right? That's how we would think about it in a RAM continuation context. And actually, let's zoom in a little bit here so we can see a bit better. And then you go to bar 20. Okay, clearly nothing there yet. Now the thought becomes what? Yeah, maybe big sideways trading range. Then 21. Now, a lot of people rolling over from bar 21 into bar 22 are going to be watching for a cleanup on bar 22 with a short setup. Okay, a couple of things. You guys have always heard me say, after a trend, I'm looking for at least 2. If I'm only going to, if I'm going to take a continuation setup counter trend after only 2 bars, in this case, bear bars, they better be just about the cleanest bars you've ever seen, and there better not be anything in the way. If I'm going to take a reversal setup, or I suppose a continuation setup, in the opposite direction of what the trend was, typically I'm going to wait for at least 3 bars, and they better be clean. 21 already is breaking it up. It's not extraordinarily clean. And what else, if 22 was a clean bear body, what else starts to become something to consider? Well, bottom of the barrel, right? That 20 EMA. Okay, that comes up a little bit, but it comes up regardless. We have 25,000 to think about, depending on the size of 22, though that is relatively far away. But what I'm looking at to begin with is the fact that, well, if 21 was a lot cleaner, it would put the close of 22 a lot deeper, wouldn't it? But since 21 was such a small bare body, even if 22 is clean, we're still, it's not 3, or I suppose a 3 consecutive bare body continuation ram setup, as clean as I would need it to be to go counter trend like this, because 21 was relatively ugly. Now, while 20, 21, and then a clean close out of 22 would be perfectly acceptable if it wasn't counter trend, if it wasn't occurring in the opposing direction as we just got this move from 9 to 19. In this context, after a big bull trend, if 22 closes down here, I'm waiting for 23 to put us well beneath that 20 EMA, get us a little, below the wick low of 15. I would probably pick the wick low of 15 there just because I see it. That puts us beneath that 20 EMA. Below the wick low of 14, as long as those bars are still within reason, great. Now we're thinking about the 50% retracement point. But now we're starting to get in the ballpark of a conversation for a setup to the bear side, right? What this entire talk here is about is on bar 21. A lot of traders are looking for that on a bar 22. Now, I just explained to you why bar 22 is a tall order for me personally. Because 21 is what it is. But what are a lot of those traders forgetting? They're forgetting the following, right? Always keep this in mind. Not necessarily to take trades based on the idea, but you should just understand the probability. The same way that in regular volatility environments, you're typically thinking, okay, when the market's ranging, about 80% approximately of range breakout attempts will eventually fail, right? This is one of those things. After bar 21, with a huge trend from 9 to 19, or a big move, I'd call it a trend. What is the far more probable occurrence if the market's going to reverse anyway? A range before it does so. Okay, this is the entire point of this talk. The market, after a trend, will far more often than not enter a sideways range before it reverses, rather than just seeing a big A-frame type reversal or coming up out of a bear trend V-shaped recovery. The more aggressive a trend is, in many cases, the more likely it is to range sideways first before reversing. So a V-shaped recovery very often starts looking more like a U-shape. And then flip it for heading back downside after a bull trend. Right, call it the A with more of a flat top compared to the harsh triangle top. Whatever, right? The market, it is uncommon for the market to make a hard trend in one direction and then reverse without ranging at all. It would be uncommon for the market to do. Now, again, you might look at this and say, well, Nico, what about this? Well, I wouldn't call this a trend, right? 5, 6, 7, 8. This is very arguably a trend. If the market decided to do this and come all the way back without ranging up in this general vicinity, that, of course it can happen, big dog. Of course it can happen. The same way that the first breakout attempt of a range can happen, but it's the lower probability event. The higher probability event when we're sitting here in real time watching bar 21 close into 22 is that regardless of whether this move continues higher or reverses completely, regardless, before it does either, especially before it reverses, the higher probability event is that it enters a sideways trading range, for a period of time. Especially if it reverses. Okay, so when I'm looking at bar 19, 20, 21, although I am open to getting short in a couple of bars, 100%, I still got to think about how clean is the setup, 50% retracement point, 20 EMA, bottom of the barrel. You want to look at volume weighted average price? Fine, whatever you pick. But what I'm really looking at here is, okay, hey, biggest concern right now is, do we enter a straight up sideways trading range here on the 5-minute chart? Okay, and then you look at this. Oh, big recovery out of 22. Are we heading higher? That's what I'm considering now, right? Trading range. Look at this. Look at this. Goodness, I didn't even realize it lasted this long. Look at this. Ridiculous. Big sideways range. And then we zoom back out. Then it reverses. This is so common. After a big push, it's so common to see a sideways range. Now, after the range, you start thinking, well, which direction is it going to break? The probability is approximately 50-50. Treat it like a regular sideways trading range, where if it's wide enough, maybe you head down from the 5-minute, maybe you head down to the 2-minute and do some scalping if it gives you setups inside the range. But on the 5-minute, if it's a relatively tight sideways range, which way does it break? It's about 50-50. Let it do its thing. Trade the setups as they come. Okay? That is a piece of information that has kept me out of trouble a whole bunch of times and is more than worth knowing within the RAM framework. All right, guys? Hope that helps. The importance of fluidity as a day trader. Now, throughout your career, you are going to see a tremendous amount of range markets. Perhaps you're upset about this. Well, a lot of your time is going to be spent trading in range markets. You better get used to it. You're going to see a whole bunch of trend markets. We love it, right? And everything that is sort of both at the same time. Okay, which is more of a normal market. Now, right off the bat, let me be very clear. When I talk about context within RAM, usually I'm referring to it intraday. Okay, but there is also an overarching market environment context that, as RAM traders, we got to keep it in the back of our head. Okay, for example, if you're seeing a potential stop hunt opportunity, like here, for example, let's look at bar 18. This is a 5-minute NQ chart, by the way. You're like, I could stop hunt the wick low of 8, right? Right? Or no? Look, 18 in this case makes a lot of sense to try to stop hunt it, in my opinion, if you're looking for a scalp. If you're looking for an intraday swing, there's nothing here that says that perhaps shouldn't be done if you're simply considering, the last 18 bars. This is where overarching environmental context comes in. For context, whenever you're watching this, the last 4 to 6 weeks, the market has been extraordinarily hesitant to break out. It hasn't necessarily been so dead volatility-wise. The volatility's been fine. But it's been big intraday ranges with a lot of hesitation at the highs and lows of day. That's just what we've been seeing. Breakouts, I always say about 80% of breakout attempts will eventually fail in a range market or in a trading range in general. Right now, I'd put that number at 90% plus. Okay, not that bar 8 to bar 18 was such a developed trading range. It wasn't, but it was a stop hunt, which is a breakthrough and beyond low of day. We know that those have not been going very far lately, if breaking at all. And you can see we went ahead, we took it out, scalp makes tremendous amounts of sense. If you're looking for a high probability, lower reward to risk scalp, makes a lot of sense. And then we came right back into the range. Okay, you have to be fluid as a trader. Now, I'm the first one to say, I would love if we didn't. If I could just have a set of 3 trading rules on a post-it note on my monitor and I just show up and I do that every day, great. But I'll also tell you this, I mean, being that that isn't reality, I'm sort of glad that it's not quite that simple, because I'd be bored out of my skull every day. Like it or not, trading is challenging, and I think that's part of why you like this. And by the way, if it weren't challenging, the reason you're here, which is almost no ceiling potential, basically, unless we're talking market liquidity, which at that point, I mean, is, right? If this weren't difficult and required you to be fluid, etc., well, then the ceiling would be basically nothing. It would not have the same opportunity potential because everybody would be able to do it with minimal effort up front, minimal, learning, minimal discipline. And then there would not be the opportunity on the table that is here, right? So the fact that this is difficult is a good thing. And you're listening right now, you're like, Nico, man, right now, I wish it were a little simpler, big dog. I hear you. No, you don't. You don't want that. Careful what you wish for kind of thing, right? The opportunity here is extraordinary because for most people, this is extraordinarily challenging. That is a good thing because it turns into a you only fail if you quit type scenario, which most people do. What if you just don't? And you say, okay, look, I'm going to see a lot of different markets. I have a general methodology that I follow, and then I have to apply it to those different markets. So RAM, top down, starts with context, goes on to setup, etc. And you say, okay, context. Well, intraday, what do we got here? Well, on a smaller time frame, we're going to have a soft bull channel turning into a trading range, right? Again, anywhere on the chart, look at it, you can come up with intraday context, right? That should always be top of mind. But then you're looking at like bar 18, and it's closing in 15 seconds. And you don't know what to do. You're confused. We don't like being confused within RAM. I don't like being confused. I want clarity as often as I can have it. So you look at bar 18. If you're confused, you need to go to context. And if you're looking at intraday context and you're like, I don't know, Nico. I mean, look, it could be a sideways range, but this is only the second test, really. Yeah, it could also be, I don't know, maybe what if it turns into this, right? What if we use this test and then we end up blasting through and turning into a big soft bear channel? I don't know. Zoom out. You're confused. Because it's early in the day at that point, bar 18. It's still, we're 90 minutes into the day. So what can you think of? Well, let's nail down some clarity. This is a continuation stop hunt trade at its core. Okay? What's the grade on this thing? B-ish? I mean, look, 16, 17, 18. It's not the most pretty setup in the world. We're way too close to the stop hunt for it to be a great setup. You're looking at B-ish at best here on bar 18. coming right into 24,000, by the way, tier 1 level, but it'd be the second test of the day, and it's not an S tier level, so I'm not too worried about it. If you're still confused, what do? You need to fall back on environmental context. Okay, it's a stop hunt. Have we been seeing a lot of trends lately? Well, not particularly, right? If you've been seeing a whole lot of range trading and breakout attempts seem to be failing at a higher rate than the average 80% eventual failure rate of breakout attempts of trading ranges, well, what do you know about a stop hunt then? The probability that it's going to break that low and just go, which would turn into at least a soft bear channel, if not a bear trend, is even lower than average, because that's the market environment we're currently in, which shifts, by the way. So you look at bar 18 and you say, well, I don't think I want to take it for a big old, 2R intraday swing type trade. And if you do want to take it, you don't just want to skip it because you're like, well, I like the setup. I like to be more active. Let me put it on. Where is the sweet spot that fits intraday context, environmental context, risk, probability, the setup itself? Well, the sweet spot is scalp. Maybe look to get a little bit better than half an ATR out of that trade. Right, you stop hunt the wick low of 8, go a tad further, look to pull it, maybe, better than half an ATR or so. Now, if you go ahead and risk the high plus a point of bar 18, that's negative reward to risk. It's a scalp. A lot of scalps are negative reward to risk, right? Because they're higher probability. Like this trade is. But a lot of traders, they don't necessarily understand that spectrum that we always talk about. It's a relationship between reward to risk potential on that particular trade and the general estimated probability in your head of that particular setup in the current market environment. Right, you throw it in the barrel full of water and look at it, say, does it float? If it floats, you say, yeah, I think I have positive expected value there, throw it on. Manage as necessary, stay disciplined. Okay, that is being fluid in the current market environment. Now, this same setup, bar 18, right, which, really interestingly, did go for a scalp, maybe even a tad more, and then right back into the range. This is not all that unexpected. Okay, but if you look at bar 18, and let's change the story here for a second. Let's say, okay, hang on now. We're in a trend market. We've been seeing bear trends break out 60, 80% of recent days. It's been crazy. You think I'm putting on 18 for a scalp? Probably not. Most times I'm putting on 18 for at least a full ATR day trade. At least. Man, if not more. If not more. But I think it makes a lot of sense, especially those of you guys trading prop firms. In this case, put on maybe a 1 ATR or 1R day trade, pull it, and then look for the next setup. But if you're going to do that, you're going to pull it, and rather than looking for more than 1 ATR or maybe 2R or 1.5 or whatever. ATR being average true range, right? R being risk on the trade, the amount of points at risk. If you're trading prop, you got to be willing to put on the next trade. Okay, otherwise you probably would in a trend market make more money and be better off swing trading it. Okay, but with prop firms, obviously we have drawdown to deal with, etc. So a lot of times it's better to pull it at, even on a regular day trade, 1 ATR, 1R on a lot of them, and then you got to be willing to put on the next setup if it comes. which a lot of times it will, especially in a trend market. Okay, again, being fluid to the environmental context of the overarching market. Again, reminder, when I'm looking at a chart and I'm talking about context intraday, typically I'm talking about the intraday context. But there's also that environmental aspect to it where, hey, what's the last 2 weeks been doing? What's the last month been doing? What's this quarter been like? Are the bears going to have a lot of confidence to take us down through? Or are there going to be buyers a bar or two, or maybe shortly thereafter, the break of low of day, because the bulls know, hey, this is a range market. The probability is better than normal that we're going to fade back into the range. Right? These are logical things that I'm saying. I know it's making sense to you because this makes all the sense. It was the only thing that made all the sense in the world to me when I started looking at charts this way. Okay, fluidity is extremely important. You must be fluid. That doesn't mean that you trade however you feel like each given day, necessarily. I mean, eventually someday when you're a 15-year vet, if you decide to swing trade one day and you want to scalp the next because you just like being more active, have at it, man. You earned it at that point. But in the early days especially, it's very important, you can't just be fluid because you feel like it. You have to be fluid to what the market is telling you to do, even if it means trading more like it's a range environment. Right? More scalps, less larger targets, less stop hunts in a range environment. And all of a sudden you see a trend market for 6 weeks. A lot of back-to-back high of day stop limit buy entries. Buy high, sell higher. Buy high again, sell higher again. And vice versa for a bear trend. It's all in the wheelhouse. And the beauty about this is when you start seeing, or when you have seen, even just once, you've gone through a market cycle where you've seen a range market, a trend market, and you've kind of come all the way back to a brutal range market. Once you've seen it once, every day is different, but I really feel like once you've seen it once, you've kind of seen it 1,000 times sort of thing, because you dealt with so many days in that cycle individually. So, really, guys, part of this, if you've been having trouble with the market shifts, which, by the way, the market shifts, man. It's not going to be all roses all the time. If you come out of a hot trend market and all of a sudden it's a cold, low volatility, brutal, news-driven, touchy, scared of its own shadow type range market, you might feel like you're struggling compared to the previous market. It's okay. This is day trading. It's volatile. And there's also a ton of opportunity if you're somebody who can handle that, which is why you're here. All right, you can handle it. You just got to hang in there through that first cycle, the first maybe couple of cycles going range, trend, back to range. And you know what? It might take a few weeks. It might take a few quarters. But once you come back and you're like, man, I feel like I just went through a whole cycle or 3, you're going to feel a hell of a lot more like a seasoned vet than you do right now. And the next time it'll be easier. And the next time it'll be a little bit even easier than the first time or than the second time. All right, guys. All right. Hey, let me know if you have more questions on this. Obviously, being fluid is a deep topic that we talk about a lot here in the Tomb, and I will continue to touch on. But let me know if you have any more questions on this. All right. Hope that helps. I wanted to take a quick second here and just very, very brief talk for you guys about making slight adjustments as we head back into a more volatile period. So, depending when you're watching this, because this happens all of the time, right now, as of this recording, we happen to be in a period of time where volatility, the last, we'll say 6 weeks, has been just dead. And in the past day or two, it seems that volatility may be creeping back into the market. Okay, now we'll see how the next few days play out. Again, it's always a little bit up in the air. Is the volatility return going to be based just simply on news and then it's going to die out again, or is it going to be sticky and kind of continue to flood back in? Obviously, we hope the volatility continues to flood back in after a very slow period, but that remains to be seen. However, when you see a day or two or 3 where ATR is noticeably higher than it has been for a week, 2 weeks, 6 weeks, 3 months, it's time to start thinking a little bit about how to transition back to a more normal volatility environment, just in case it ends up being sticky, which eventually it always will, right? Volatility does always creep back into the market after a slow period, but you don't want to jump that gun too early. So you want to kind of ease yourself back in to normal volatility trading. Obviously, when volatility conditions die off, we make slight adjustments. We talked about it in one of the RAM live trainings, right? Making adjustments based on volatility. And in low volatility environments, of course, there's going to be a lot more range scalping, a little more hesitation on less clean and less contextual continuation setups. And then as volatility comes back in, how do we approach that? What do we do? Well, you have to be nimble. I think the best comparison here is you don't want to approach the market like RAM in general, like you're a big tanker ship. You're slow, moving in and out of port. We want to be a speedboat, okay? We make adjustments fast. That's how you avoid when volatility starts to collapse. That's how you avoid giving months and months back over the course of a week and a half because you're slow to recognize the volatility adjustment. And instead, during that time, you're able to maybe capitalize on new opportunities that arise that you would have missed. It's not just losing the money if you start missing context because you're missing the volatility adjustment. It's also opportunity cost, and that goes the same way as volatility starts to expand from a tighter environment. Okay, you got to start giving good continuation setups a little bit more trust the more volatility starts to kind of pull out a little bit and expand. All right, but you got to be very careful in the transition period, okay? Because again, if it's only been a day or two of, hey, it seems like ATR is a little bit higher throughout the entire day than it has been. What's going on here? Is volatility going to stick back and start to actually come back in and expand, or is it going to die out again for another 3 weeks over the next day or two? You got to be careful. Okay, so this is a transition period, but you want to recognize that we may be entering that transition period as early as possible, within a day or two. Ideally, like 1 day. If ATR has been 11, midday for weeks and weeks and weeks, and all of a sudden here today, at one of its lowest points midday was in the 30s. And then in the afternoon, the lowest it got was in the high 20s. All of a sudden it's like, okay, something might be shifting here. So it's time to start thinking about that. Okay, now as far as range trades are concerned, range scalps within RAM, same deal. Looking to buy small to moderate bear closes in the lower third of soft bull channels, looking to sell small to moderate bull closes in the upper third of soft bear channels, and then regular continuation trades, whether it's stop hunts, high or low of day continuation trades, or continuation trades in wide ranges, especially wide soft bear channels or soft bull channels, which that's a change. That's an adjustment that we have to get back used to, right? Or get used to doing again. In a super low volatility environment, you don't end up with a lot of soft bull or bear channels that are wide enough to have quality RAM continuation trades inside of them. They're just not wide enough. But as volatility starts to expand again, like you look at the selling the close of bar 27, open of bar 28 here today. What was that? That was continuation inside of a big soft bear channel, right? Beautiful trade here today. Beautiful ram trade. Okay? When the volatility is very, very, much so collapsing, most of these channels are too tight for good continuation trades to actually develop inside of them, because you need multiple bars to get a good continuation trade. Today we needed bar 25, 26, 27 on this chart, for example. Doesn't matter when you're watching this, by the way. When ATR is, 9, you don't get too much of that, right? The channels just don't tend to develop wide enough. So if you've been through a period of time where volatility has been very low, and it's starting to widen out again, what do we got to do? You got to be a little bit more picky of your actual limit order reversion scalps. You have to be a little bit more open to your inside of a big, soft bull or bear channel continuation trade development. And you have to be a little bit more trusting of, stop hunt continuation trades, high, low of day continuation trades. Doesn't mean that you should just trust everything you look at, but remember, within RAM, look for the high quality setups, and when volatility starts to expand, like for example, especially those stop hunts in low volatility environments, you guys will very often see me say, I don't trust the stop hunts are going to break and be as aggressive in a low volatility environment nearly as much. Whereas as volatility starts to expand, all of a sudden it's like, oh, hold up, we're taking a lot more stop hunt trades now. And on average, over a big sample size, it's like, hey, they're working at a higher rate right now. Because when you get the break, you tend to actually get that break. And when you get that break, it tends to break more, of course, than it would in a lower volatility environment. Not to imply that every stop hunt we look at is going to work, right? But for me, it's a very good setup. Okay, one of my favorite within RAM. Works better in moderate to higher volatility environments than it does in very low volatility environments, of course. So these are little changes that we got to be open to and willing to adapt to. And by the way, this is an art. This is not so much a science. This is an art. Understand that as, if it's been 6 weeks or 2 weeks or, 3 months, depending when you're watching this, of low, frustrating, small volatility. And all of a sudden, it's like, wait a second. It's been a day or 2 or 4. Volatility's starting to come back in. The average ATR midday is quite a bit higher than it was 2 weeks ago or last week or, 3 days ago, whatever. It's time to start thinking about these little adjustments. Be open to it very quickly, but don't jump that gun, the first 10 minutes you see a little volatility bump. The art in this is timing and being patient with your transition back to making little adjustments based on the volatility. Don't jump the gun, but don't completely mentally miss that it's happening for a week and a half. And you end up, again, not only decaying that edge, because you're trading the context improperly or you're reading the context improperly, but also there's an opportunity cost to that where you're not taking advantage of the things that you would if you were reading the context properly that you happen to be missing because you're in the mindset of, low volatility, when it's no longer necessarily low volatility or vice versa. All right. Hope that helps. Go kill it. Question here. Did you see any channel scalps today that you would consider entering at the outskirts of the range with a limit entry versus entering inside the range with a continuation setup with a stop limit entry? Something like entering long near the low of bar 54. So buying the low of 54 here is one that I see. Granted, that one would probably stop you out. Thank you for everything. Okay, so my response is as follows. Let's go through the whole day and take a look at this and zoom in, because obviously we have this big CPI bar that's going to throw off the scale. So if we zoom in here, and let's go kind of through, well, we're just going to have to deal with that bar for now. So let's look here and actually zoom up. So if we go ahead and draw this, the morning I was looking at a channel through here, And I was looking at that on stream for a very long time and ended up being correct. Now, throughout all of this, there wasn't a lot. Okay, this was all very ugly. A lot of inside closes, a lot of channel closes. Everything was inside of something else. There really wasn't anything for me that was reasonable until the close of 21, which I bought above with a stop limit buy. That right there is continuation using a stop limit buy inside of the full day's trading range, which was a very logical trade, ended up working rather well. Now, from there, if we go ahead and get rid of these, and let's look from bar like 23 onward, you still, and actually while we were live, I started talking about this as well, right? Because what happens is, we better draw this again. What happens is when you get these big full day trading ranges, eventually, really, really commonly, what will happen, pay attention to some charts, you'll start seeing this when the full day is ranging. One side or the other tries to cut that range in half or more. In this case, it was the bulls, right? Buying this up, trying to break this out higher, trying to get the bears to kind of lay down so the bulls can finally take it outside of the trading range by creating a support level here a little higher than in the middle of this big trading range. They tried to do that for over an hour until they finally kind of got to push higher. But that trading range there, again, there were no closes even near the low. It was just wicks. So as we move forward through the day, this kind of started to become a thing. But as far as width, you know, you're looking at maybe 30 points-ish, 35 points at best. That's kind of tight, you know, but you could look at that and say, all right, well, this is a soft bull channel now. I mean, it's just about the softest bull channel you could ever get. But yes, it is within reason, a soft bull channel. Okay, something that I see that you could do that might make sense is, I don't like doing the hindsight thing, but if you were looking at this, you would probably have it drawn like this still. Okay, but if you wanted to, you know, you could buy the close of 39. I don't think that's an incredibly good trade, but you could do that. That would be semi-logical as things come higher and higher and you're seeing wicks go higher and higher. It'd be semi-logical. It would have worked in hindsight, but again, in the moment, I don't think it's the greatest trade of all time. And now you enter this big, really, really, really soft bull channel. Okay, now what do you do in here? Well, if you really wanted to try to force stuff, yeah, I mean, you could start saying, okay, I think this is turning more into this. And you would have seen that, at least by bar like 46 here. Okay, then you can start thinking, well, let me front run and buy the close of 48. You know, would have taken on a little bit of heat and then it worked. Again, not the greatest trade, like B- at absolute best. Because what could you also draw? You could also draw this, right? So that's not necessarily something I would take, but in an eval or something, you could throw on a buy on the close of 48. Don't make a habit of it. You know, it's not a great habit, but, you know, it is within reason. It's more reasonable than what most people are doing. Buying the close of 54, like you said, is also a reasonable trade. That one wouldn't have worked, but you know, it's reasonable, and you can't expect every trade to work, especially in a range where the edge is going to be a little bit smaller naturally because the market can't figure out what to do, right? The volatility is lower. When that happens, the edge starts to go down a little bit. Doesn't mean there isn't any, okay, but it starts to get a little harder to come by. Now, as we go through the high 50s, low mid 60s here, all the way into the 70s, this here, I don't really think anybody should be doing much of anything in this. Okay, because while this is live, you could start making this argument, and then by the time 67 closes, you could maybe make sense of that. I would be saying let's wait for 68 because of this wick high. If we can see 68 close up here or something, all of a sudden I have a stop limit buy ready for the bulls. Of course, we didn't get that. Really through this, guys, you want to make the biggest leap forward you possibly can in one day? Stop trading this garbage when ATR is 12, 13, and we're in a tiny little trading range that, if we're being generous, is, 15 points wide. That's ridiculous. A 15-point wide trading range. That is not territory for active intraday traders. There's just nothing there. You have to wait for something else to happen. 67 started to look like maybe something would happen on 68, like we just talked about, but I would have need to see needed to see 68 closing well outside of the wick high of 52. Okay, which, also happened to be the high of day at this point. We zoom out, you can see that. So as we come in later in the day, things started to get a little better as far as volatility. Just looking here, it's like, well, what makes sense to do here? Well, if you really wanted to be aggressive, shorting the close of 74, that all of a sudden makes logical sense. Would have eventually worked, would have taken maybe 15, 20 minutes into the close. Shorting 74, though, would have made some sense, though you got to keep an eye on the 340 and 350 algorithms, Eastern time, right? But that would make some sense there, because you're closing, beneath the wick lows of 68, 70, 71, below the 20 EMA, 2 consecutive bear bodies with a third, that's a doji. And you would say, okay, well, there's probably a big trading range here, right? So shorting the close of 74, if you could get a fill, is kind of an uglier version of the trade that I took on stream, buying the close of 21. This is a much better setup, okay, but it's similar, just to the other side. You could have shorted the close of 74. That would make sense continuation-wise. As far as what else could you have done here? In the moment, I don't like looking at hindsight again. I like to zoom in a little bit. There we go. And then look at things. By the close of 52, you wouldn't have known that the trading range is there, because by the close of 52, it looks more like a soft bull channel, right? So you wouldn't really short the close of 52. And if we keep going, by the close of 68, if you wanted to really be early, you could say, okay, well, I'll short the close of 68. But I'd be looking for 69 to potentially be a bigger bull body and close way outside of here for a stop limit buy. So I would have waited for 69. Rather than shorting the close of 68, I would have waited for 69 to see if we got that bigger bull body. Of course, we didn't. It just remained in the trading range. If you really wanted to do something by 71, you could short the close of 71 and put your stop above the wick high of 52. That's a logical trade here as we go bar by bar. Now, eventually, again, you would have come into 74. Would have made sense to short below 74 using a stop limit sell if you could get a fill, risking 74, the signal body, right? Risk on that trade would have been tiny, 12 points, and you could have easily made, a full ATR, 1R. You could have made much more than that. Not that you necessarily go for that because you're looking at a trading range here, right? So let's not pretend like we would have caught this whole move. That's the closing bar right there. You would have taken this off probably at about 1R. So, listen, guys, volatility was really, really slow in the afternoon today. You got to learn to be patient. If there's no quality setups, you're not taking anything. Guess what? That's part of this job. But that keeps money in your pocket and keeps you profitable while everyone else is hemorrhaging dollars. And then when the good setups come around, when volatility's high, guess what everyone else says? They say, well, I'm not very confident. I don't have an edge. They don't actually say this. They just say, I'm scared. Volatility's too high. I'm going to hold off. That's when you book up all of your profits or 80% of your profits. And then when things slow down and everyone goes, oh, things are slow, it's safe to trade, they just get chopped to hell because the market can't figure out what to do. And edge is much more difficult to come by when the market is doing this, 55 through 60. Edge is incredibly hard to come by in there. Okay. Whereas when things are more volatile, like they were a little more volatile through here, the close of 21, all those people who are just losing through that tiny little channel are scared to put anything on. That's where we're making our money. And then we have the patience to sit through this while everyone else is hitting little losers, right? Because it's slow, so they feel safe. They're less scared. Guys, when it's that slow and just ranging, the edge, that's when you should be nervous and scared. Not scared, but less, likely to put something on, right? Because the edge is much harder to come by. When volatility's high, assuming, it's not like a tariff situation from months and months ago where we had, 200, 400 point moves in minutes, that's just news volatility. That's crazy. But if ATR is 60, everyone else is terrified to trade because they lose when ATR is 15. And they're like, oh, I can't trade. ATR is too high. It's like, no, that's when we should be trading. Just trade smaller. If you're scared, size down and still take the setup, man. The volatility being higher, getting beautiful continuation trades, that's where the edge we can come by a little more easily. When the market's doing this, 55 through 60, 41 through 44, no. This is doji. The market cannot figure out what the hell to do. How would we be able to? Right? The edge is really hard to come by. Leave that for the algos and the degenerates. And if there is a clean range, which, the cleanest range today was the full day's range here, right? We took continuation, or at least I did. Bought with a stop limit buy above 21. That right there, for me, that was the trade of the day. Okay, and the rest of this, the second best trade of the day, I'd say, is shorting the low of 74. And it wasn't even that clean, which doesn't say anything about RAM. It just says a lot about today's volatility, which we all saw was really, really low. So these low volatility days are okay. You can still pull some points out of the market. You absolutely can. And you still will have an edge if you have the patience to sit through this garbage, right? This garbage. While everyone else is taking little hitters because they're confident because the market's slow, so they're not as scared and they just lose and they wonder what the hell is going on. It's like, well, yeah, you're trading when the edge is the most difficult to come by and when the edge is the quote-unquote easiest to come by, right? When it's the most available, when volatility's higher and things are really pushing, they trade too big, so they're scared. They're like, I can't trade right now. It's too volatile. No, that's when you should be trading. Size way down if you're scared. Put it on. If you're trading RAM, nice continuation setup, risk the signal body. Look for, if it's a scalp, half an ATR. If it's a scalp / swing, 1 ATR or 1R. If it's a straight up swing trade and you got to go and you're going to be back in 3 hours, set your server side orders. And if there's room, look for 2R. Okay, and then sit through and be patient through the sideways doji after doji garbage like 41 through 44. While everyone else is losing and blowing their accounts, you'll be protecting the gains you had earlier, waiting for the edge potential to come back. Okay, hope that helps. I want to issue a few reminders here. When you're going through a transition period from a higher volatility market environment to a much lower volatility market environment, that happens to be what's going on in the market right now. The chart that you're looking at, we saw, this is a 5-minute NQ chart, by the way. We saw ATRs, look at this, in the 9s during the New York session. So, safe to say that we're seeing a much lower volatility environment here, at least today. Yesterday also, again, it doesn't matter when you're watching this transition happens constantly, and you always need to be, on your toes and reminded of the things to double check when this is happening. But, yesterday, ATR was coming in as well. And a week or two ago, we were seeing ATRs in like the 70s. 50s, 60s, 70s, depending on time of day. So this has definitely been another one of those transitions. This is nothing new, by the way. This will happen to you constantly in both directions, high volatility to low and vice versa. But there's always some reminders that you need to keep top of mind while this is occurring. And, I want to focus here on from a higher volatility environment very quickly coming into a lower volatility environment. Now, what do we know on the averages about breakout attempts? That's approximately 80% or so of breakout attempts in a range are going to eventually fail. Now, what happens when volatility starts to fall off a cliff over the course of a week or a few days or a few weeks? Well, the market starts to tend to range more, doesn't it? And it also tends to be single bar, very small width, sideways trading ranges for a lot of that time, correct? Look here today, bar 59, all the way through like bar 70. What is this? The ATR during that whole period was like 10 or less. And a really dangerous trap that a lot of traders can fall in when this is occurring, especially when, 4 trading days ago, they were trading, big, happy ATRs of 57. Not even necessarily right off the open, like pretty deep into the day. It's a beautiful thing. And then this happens. I'm always very encouraging that you come, or I should say, I always encourage traders to keep it very, I'll say top of mind, that every day when they come in and they sit down at their battle station, right, to get to work, to trade, for the most part, I don't want you having a bias. And that means directionally and volatility-wise, okay? I just want you to trade what's in front of you. Keep this simple. Simplicity when following a proven methodology and you have confidence in your edge, simplicity pays, and it will keep you paid, and it will keep you confident and consistent in your edge. If you start coming in and saying, man, I can't wait. Yeah, the market looks kind of slow, but yeah, ATR was 70, 3 days ago. We'll get back up there. Let me just get long for the expansion and volatility. All of a sudden, you've stepped out. You are now being unfaithful to what's been working for you, correct? To what gave you the confidence in your edge to begin with. And you're going down the rabbit hole of decaying self-respect, which is going to put your confidence down the tubes and your performance right with it. And it's tough to get out of that hole. When the market starts doing this, and it can turn quick, believe me, this is going to happen all the time in your career, back and forth, high to low, low to high, high to moderate, and moderate to high, high to low, low to moderate, and moderate back to low. So often that I think you should come into basically every day with a clean slate. You can recall that yesterday was wow, what a tremendous 84 ATR. That was crazy. But be ready for anything, because you might see bar 59 through bar 70. And if you have that in the back of your head, that's a bias. That will, like it or not, it's going to influence your decision making. And even if it just does so a little bit, that can cause inconsistency in your decision making, which is ruining your data set, therefore your edge. When the market starts ranging more heavily and single bar sideways trading range ranging more heavily because volatility is falling off a cliff. And by the way, if you're having trouble following me, ATR, that's the average true range. That's the average range in points of happens to be 5-minute bar, since we're on the 5-minute NQ chart. Okay, it's a volatility indication, basically. Heads up data display shown in the bottom right of your screen says 14.04. You're on bar 78, and it looks back at the last 10 bars. Okay, that's what gets averaged in. That's how I have it set up. When the market starts ranging more heavily, especially when because volatility is so low, that 80% of breakouts will eventually fail number, it will start to creep up a little bit, because now you're also fighting volatility. And any move outside of that range is not only trying to break the range, it's also trying to break this preconceived notion that the market has that this probably shouldn't go very far because the market's dead. Okay, does that mean you should just blindly short it if it pops higher? No, right? We're trading price action. We're trading price action. Stay true to that. Very important. Okay. But I also want to put this out there. I really don't want you to be scared of a slow grind type of day. Because, guys, it's not all that uncommon that you'll get a clean, not necessarily here today is not a great example, but it's not all that uncommon that you'll get a clean, low volatility, granted, But clean, slow grind, let's say bull trend, for example, I don't want you to get it in your head that, oh, just because the ATR is less than 25, I can't make money. I think as long as that ATR is above 10, it's reasonable to sit in the chair and get some work done. If the ATR is like 3, for me, it's time to walk away and go do something that's good for your mental health, or hang out with your husband, wife, whatever, because that's a better use of your time. It's a better ROI, so to speak, so that you're fresh when you come back and work when the market's actually of an appropriate volatility, right? But as long as that ATR on a 5-minute NQ chart, for example, is above 10, I think it's worth sitting, especially above 20. I'll commonly say below 20, our job gets a little more difficult. Below 10, it's probably time to walk away. But if you have an ATR of, 22, 17, whatever, and it's a very calm, slow, grindy move, but it's you look at the price action, like this is a bull trend. It's not out of the realm of possibility that things will just so happen to line up where you end up taking 12 trades. 7 trades, 9 trades, 13 trades. That can happen. I don't want you to completely, be filled with fear or write off the day entirely if the ATR is not 52. If you start doing that, you're not going to trade half of days at least, which is problematic because we need that sample size to get bigger, right? Procure the edge and then beef up the sample size. It's the business model, right? But I also don't want, again, this is all, have you noticed? This is all kind of finding the sweet spot. Do not be fearful. Do not put, bad mojo on low ATR days that are still high enough to be in the chair to sit at your battle station, right? But I also, I want you to keep in mind that the market can act a little differently when ATR starts getting low, such as that 80% number starting to creep up even higher. Okay. When the ATR is 71 on a 5-minute NQ chart, there's at least for a big chunk of the day, there might not be a lot of ranges. And if there are, they might be really wide to the point where there's continuation setups happening inside of the range, which we love. Because that can oftentimes also lead to stop hunts if you have a clean high or low of day, a mature level, right? And then all of a sudden, ATR starts falling off a cliff. And you got to kind of take a step back and look with a fresh set of eyes. Forget about how well you performed 3 days ago. It's no longer 3 days ago. It's a new market with a new volatility. If it's a single bar sideways trading range, you're like, there's basically no edge here. And you're sitting on your hands. But if you're getting, a soft bull channel, soft bear channel, a slow, grindy trend, true trend, even if it's slow one way or the other, and there are RAM setups that fit the context, put them on. Put them on. Okay. But all that to say, I think it's more important that you come into every day with a fresh set of eyes than it is to try to trade so differently based on what the ATR is. That's not what I'm getting at. What I'm getting at is all of the things that I just said, within RAM, you're already doing them no matter what the volatility is. Top-down system, tier 1 context, tier 2 setup. Make sure you're sized appropriately. Be patient and disciplined, right? All the basics within RAM. You guys know this. The problem is, if you are breaking little rules, especially, this can start to snowball, which again, you shouldn't be doing anyway. But if I've seen traders do this, they'll break little rules here and there. They'll lose patience and they'll take the trade before the early trade, for example, but the volatility's high and it's worked for them, 3 or 4 times. Small sample size means nothing, right? But they start to learn that behavior. And now it starts to snowball. Volatility tanks. The percentage of breakout attempts that fail rises. And now they're no longer getting away with it. And they get frustrated. They start to spiral, make more mistakes. And now they're in a hole that's, again, not so easy to get out of. Okay. The entire lesson that I'm trying to drive home here is there's little nuance to different volatility, like we've talked about so many times, different volatility environments, that is. But I really, really, really need you to come into every day open-minded with a fresh set of eyes. I don't really care what happened yesterday. Today could have an 85 ATR or an 8 ATR. It could be a big range or a giant trend. And everywhere in between, no matter what the volatility is, it could do anything. We're price action traders. We let the market, quote unquote, tell us, right, what to do within reason and logic. We're patient and disciplined. We execute, accept the outcome, and move on. That's trading with an edge and a positive expected value. Okay, again, assuming you're doing logical things, which within RAM, that's the entire point, right? All right, guys. All right. Hang in there. No matter when you're watching this, if volatility's coming in, keep this in mind. Even if volatility's expanding and you're watching this right now, similar deal here. Keep this in mind. Okay, but if you come in every single morning with an open mind as to what could happen, you don't even have to think twice about this. You'll just trade what's in front of you anyway. All right, guys. Hope that helps. Tips for recognizing when the move is over. Okay, so I have a few tips I'd like to throw out to you guys here in the tomb. Now, of course, if there were a magic bullet, we'd love to have that. But there are certainly some things that you can take a look at to try to better understand what's going on so that you don't go ahead and blow up a huge day within a sideways trading range after a big, nice, beautiful trend move. Today's a very good example. This chart on your screen is a tremendous example of exactly what I'm talking about. So I know it happened to some people today. Okay. And I have a few things that I think about when we're looking at like bar 25, bar 26. This is an NQ 5-minute chart, by the way. So first of all, in order to understand what we're looking for, you first have to understand the move itself. This is a clean bear trend. Very much so. This is not a soft bear channel. This is not an aggressive bear channel. This is just a straight up bear trend. Okay. Now, first of all, you got to understand when you see something like this, it's a little bit different than if you were to see, let's say bar 20 through bar 26, and then it faded and went again. That we would call either a soft or more aggressive bear channel, depending on the pitch, or I should say the aggressiveness of the move downside. Is it kind of meandering downside, or is it making a pretty hard move downside? Okay, really what you're looking at, to oversimplify that, the closer to horizontal, the closer to a sideways range it is, the softer the trading range is. Okay, the channel is. I'm sure that makes sense to most of you by now. So this, though, from bar 13 to 24 is a straight up bear trend. Okay, now when we have a straight up bear trend like this, you see 25, and by the way, for a lot of RAM traders, through here is going to be a tremendous time. A lot of people trading RAM had really, really good days on this move in particular. Again, it does not matter when you're watching this. You'll see moves like this periodically in the market. Okay, and you want to be able to recognize them ideally as they're happening. And in the beginning, they will present themselves as normal RAM continuation setups, and then it'll just keep going. And then you'll have another RAM continuation or 2 or 6 to put on. Okay, now when 25 hit, I'm looking at this and I'm like, okay, let's see what 26 does. 26 closes above the wick high of 24. Do you see that? When that happens, this is really what this video is about. When this happens, when you see this, after a huge trend like this, buying the close of 26 is what I would call the early trade. That's very early because this is an aggressive bear trend. Coming out of aggressive trends, I like to see at least typically a 3-bar continuation setup. Now, what will oftentimes happen is you end up finding yourself right back into the 20 EMA or maybe the 50% retracement point after 3 bars, depending how big the trend was and how hard it went. But with 2, just understand that if you buy the close of 26, the probability of it working is lower. Because what do we know about moves after big trends? Bull or bear, in this case, bear trend, of course. It's relatively rare in the market, probability-wise, that you see a move like this. I mean, look at that move, right? And then you see the same thing back upside. A true V-shaped recovery like this intraday is pretty rare. Usually what you see is if you are going to see a recovery upside, you'll see a sideways range for a while first. And in that range, whether it continues lower or goes upside, is close enough to 50-50 to call it 50-50. Okay, so you have to let it range and then let it move. But back to the primary focus of this video, and I know this is going to help a lot of you guys. When 26 closes, I'm thinking 2 things. Okay, if 27 is a beautiful third clean bull body, then I have to buy the close of 27 using a stop limit buy. Right, 1 tick above the wick high of 27 if it's a clean close and look to get long. All right, assuming we're not like coming dead into the 20 EMA or the 50% retracement point or something, right? But what I'm thinking more so, going back to the fact that it's relatively rare to see a true V-shaped recovery, it does happen, but it's rare. When 26 closes and it's above the wick high of 24, you see that? It's trying to overtake. The bulls are trying to recover. The bears are exhausted. On 27, I'm really watching it to see if it puts in that third bull body, and if it can't, which it didn't, now I'm watching, okay, there is a high probability that this remains a sideways trading range, but let's watch the next few bars to see if this is just a breather and then a continuation lower, which I would trade again if it was clean. But number one risk, even on bar 27, is, hold on now, we may just see a sideways trading range. And you have to be aware of that. Okay? You got to watch it. Be patient. Wait for the setups to come to you. This is why. Okay? And then look. Oh, man, it's brutal. Brutal. We already knew that this was a very high probability of this sideways range happening on bar 27. You know, I would say bar 26, but realistically, I was watching 27 to see, okay, well, if it puts in another bull body, then I'm convinced for at least a scalp to the long side up into the 20 or the 50% retracement point or whatever it may be on any example, right? But the highest probability thing is either big sideways range or that it's just a breather and then more downside. So either way, on bar 26, 27, we have to wait, right? The reason I bring this up is that this is a really big tip, or a couple of tips, to keep in your mind when you're seeing this, because, you know, patterns, they just repeat themselves, right? They just look a tad different and they repeat themselves. You want to be very mindful of this, because a lot of people, they'll see bar, 25, 26, and it's not, a soft bear channel. It's a straight up trend, at least it was. And they'll just start shorting. And while, is it a logical thing? Yeah, I mean, I suppose it's logical if you could figure out how to manage your risk, which is a little harder, on bar like 26, for example. At least if you're taking, higher quality RAM trades. However, I don't like seeing people blow up a big day through this move by getting, I'll use the terminology, even though I dislike it, by getting chopped up. And the reason I dislike when people say, oh, I got chopped up today, is because that implies that it was the market's fault and not their own impatience. Right? Because usually when you get quote unquote chopped up, it's usually, not always, sometimes you just get chopped up, but it's usually because you were a little impatient in a trading range, and it's normally a sideways trading range, and you were trying to do logical things. But again, as we know, in true sideways, especially single bar trading ranges, it's really tough to manage risk. Even though you can find some higher probability stuff, it's really hard to make the math look good. So, then, you see on bar 42, it's like, okay, well, it's not below 25 yet. Let's watch 43. And then it's like, okay, 43 wicks back in trading range. He's going to maintain here. And it does. Okay. When you finally establish a range after a big trend, this is another one of those scenarios where you got to keep your emotional curve as steady as possible and not get it in your head that this thing's going to dump another 400 points necessarily, unless the market gives you the setup. It'll slap you in the face with the setup, just like it did from 13 to 24 on that move. Okay. After you've locked up a good day on a big trend move, and all of a sudden it's like, ooh, relatively high probability that we just enter a trading range. And then as it does, you're like, okay, which direction it goes now is basically 50-50. You got to be patient then. And this is tough. Okay, this is a psychological thing because you go from having a really hot hand during the trend and a really good day to having to kind of, cold turkey, cut it and wait. That's a big difference in emotion, and it requires a lot of discipline and the ability to recognize rather than being blinded by, oh man, the trend's going to continue, right? Even though when you get setups in a trend, it's very logical to slap it on, slap it on, slap it on. But when you start getting, 26, 27, 28, you got to really wait for that next obvious setup to come. And if it does, like, if 42 had closed beneath the wick low at 25, you're like, okay, first bar outside the range. Let's wait on 43. And then 43 is another beautiful bear body closing. All of a sudden, okay, that's another setup now. But of course, 42 closed inside the wick low at 25. It's like, let's watch 43. Yep, wick back in, trading range. All right, got to be careful. Same thing here on bar 51. Inside the range, you got to be patient. You don't want to jump the gun in a big sideways range like this, even if you're very excited about, a big trend like we had on this particular chart. Okay? All right, guys. Hope that helps. Question. Today, bar 4 through bar 17 looks like a single bar bull channel. Does this fall into the stay away from single bar ranges, or is this something else? Yeah, so 4 through 17. This here, see all these wicks, especially bar 4 through bar 14? Absolutely need to stay away. Now, there's just nothing here. Now, let's say if bar 14, for example, looked kind of like bar 11, and then you get 15, all of a sudden 15 becomes a RAM continuation setup. That is, of course, not at all what we got. Bar 13 and 14 were small bear bodies. 15 was kind of an outsized bull body, and the first of its kind. The first bull body in a potential sequence that was then broken by 16. There is nothing to trade in especially a heavily wicked single bar, either trading range or channel like 4 through especially, 14, but really 4 through 17. There's nothing there. Now, should you generally stay away from single bar ranges? Yes. And what do I mean by a single bar range? A range where each individual bar, you can kind of argue, fills the entire range, rather than trading ranges where you're getting, or what I should say is like a soft bull channel where you're getting a push, pullback, that then turns into a sideways range. A sideways range, of course, we talked a lot in today's live training, depending when you're watching this, it was 009. We did an entire hour on ranges. So sideways trading ranges have their own issues, right? But let's assume in a soft bull channel, if you're getting a push and then a pullback, push, pullback, and it takes multiple bars to really get to the top of the range and then the bottom of the range to backfill the bottom of the range. That's not a single bar trading range. A single bar trading range is something like this, technically a channel, which falls under the umbrella of range, right? Where each bar is kind of wicking the entire range, which means that either the range is tight and volatility is really high, or if volatility is low, it means the range is even tighter, which makes it even more difficult. Not that you should trade single bar trading ranges really in basically any case, even if volatility is high, but especially when volatility is really not that impressive, 35 on the ATR, 32 on the ATR early in the day like it was here. That's not tremendously high for NQ, for an NQ 5-minute chart, right? So yes, bar 4 through bar 17, effectively a single bar channel. Got to stay away from that in pretty much every case. It's really, really hard to find edge there, especially when you're looking at one like this, in this case, where it's so wicky. So wicky. You got to be patient. Let the edge come to you. Again, reminder, if the market is forcing you to sit at the player side of the table, it's not allowing you to be the house, meaning it's presenting you with a low volatility, single bar, wicky channel like that. The best move you have in your toolkit, in your quiver, is to do nothing while everybody else tries to force things and has negative expected value in doing so. The best decision you can make is to do nothing, let the market bring the setup to you, and then hit it. I want to have a conversation with you guys about slowing down and cleaning up. Okay. This is going to come up a lot over the course of your career. It certainly has and will continue to do so for myself. And what do I mean by this? So a lot of days, this is particularly true, at least for me, on range days. And I don't mean those clean range days where you're already cleaning up. I mean those range days that that come along every so often that you're having just a hell of a time figuring the market out. And you might be a trade, maybe 2 or 3, hopefully not, but maybe 7 into the day, and you're having a hard time. And it seems like you just can't win a trade, or that's what it feels like at least, even if it's not necessarily the case. On a day like the chart that you're currently looking at, I didn't get so many trades deep, but that's kind of how it felt. Even you extend it out this way, that's sort of how I was feeling. Like mid to late morning here today. And this is that feeling that I recognize and I know what to do based just on experience. And if you don't yet, here's what works for me really well. Slow down and clean up. So what I do is when I really feel like I just do not have a feel for the market. And again, almost every time this happens to me, it's when the market is in just a weird trading range. You know what I mean. It's one of those ranges you just can't, no matter how you look at it, no matter how hard you think, and no matter what you kind of try that's logical, keeping your emotions at bay, it's like, I just don't see this thing right. Slow it down, go to lunch, take your eyes off the chart, do something else, sit back in your chair for a little while, listen to a podcast, whatever. Slow down. Not only is it going to force you to come back with a fresh set of eyes, but even more importantly, it's going to give the market time to change, at least a little bit. And you know what happens a ton of times when I slow down in order to clean up? I come back, I look, and it's like, boom, I know what to do. It clicks. on a day where it has not been clicking. So you look at this trading range. This is effectively the range, right? And then at some point you have this idea, it's like, well, yeah, I mean, this may just turn into a really, really soft bull channel. That fails, heads right back into the range. You're like, okay, well, let's keep watching. You go to lunch, you take your eyes off, you do whatever you want. You come back, I don't know, an hour later, 45 minutes later, and you start watching the market again. And then you end up with this as a potential look. You have a little wedge, and you get bar 49. Okay, 49 is the early trade. On a day like today, whether you choose to take the early trade or not is up to you. 49 ended up being a tremendous trade. If you had waited, wouldn't be mad at you at all. If you had taken it, I also wouldn't be particularly mad at you. Okay, in hindsight, great trade, but understand 49 meaning selling the close of 49, risking the Wikai of 49. That was the early trade, especially on a big range day like today. But even if you're looking at this a bit later, you look at 62. Anybody's eyes get caught by 62? Mine certainly did. Just looking at this chart. Let alone in the moment, man. 62 pops up, and you're looking at this. Here, look at it with me right here. And after a big day of this, of like, I just can't figure this market out, man. Sometimes it feels that way, right? You look at 62 and it's like, bingo. It's over. I know what to do. Stop limit sell goes out, or even a limit sell goes out on the close. You risk the wick high 62, goes sideways for a little while, makes a push, whatever your take profit may be. If it was a scalp, if you went for an ATR, you went for an R, whatever you went for, man, you got it. You got it. You look at 73. Whether you took 73 or passed on it, you're like, meh, 72 is a bit too big of a bull body for me, if that's what you're saying to yourself. Or if you're like, you know what, 72 is a very small bull body, I'm going to look at that as kind of a B short setup, and I'm going to put that on. You get it, right on 74. Understand, though, by this time of the day, you're coming in close to that 3:50 p.m. Eastern Time algorithm, okay? So that better be more of a scalp than anything. All that to say, on days where you feel lost, frustrated, confused, slow down in order to clean things up. And a lot of days, it will help you clean up. You can swing that P&L big if you just slow down and clean up. Not to mention, by the way, that time where you're slowing down, crucial for many reasons. Fresh set of eyes, gives market time to adjust and change. But it brings, whether you notice it or not, even if you don't realize it, man, it brings your emotions down. If that's something you particularly struggle with, that's a huge benefit. Right? So many of you guys I know, big benefit for you, man. It helps. And you know what? If you slow down and you come back and you take a peek, and you're like, I still don't see this thing, hang it up, come back tomorrow. Fine. Or hang out through the afternoon, put your feet up, and see if you do see something clearly at some point. But it's going to hit you like a train. Bar 62, for example, you'll look at it, maybe even 49 if you're, into the early trade. But you'll look at one of those bars, man, and you'll say, bingo. I haven't felt this all day. Light bulb. I know what to do. And I'll tell you something, it feels really good. to be on the side that you know you need to be on after a day or a morning or even 30 minutes, man, of feeling confused. Nothing worse than that feeling of confusion as a trader. Okay, we don't like that feeling around here. So when you have that feeling, it's trying to tell you something. We've built a lot of things around RAM to internalize that feeling and then solve it. All right, guys. Hey, let me know if you have any additional questions on this. Hope that helps. Question: what do you think about moving to other time frames if the 5-minute, for example, has not been producing the desired results for a couple of days? Yeah, so, you can move time frames whenever you'd like. But there's something really important to think about here. You pick a time frame to focus most of your efforts on for a reason. For me, I like the 5-minute as a primary focus most of the time. Why? Because it's a really good balance between quantity of setups and quality of each setup that I do get. So, sometimes what will happen is you'll have a few days where the market shifts and it feels like the desired result isn't coming quite as easily. We have to understand that part of this is going to be a grass is always greener effect. And I see this just plaguing the trading industry. I don't mean jumping from time frame to time frame necessarily. What I mean is jumping around everything. People strategy hop and they end up spending, 12 years to learn when it should have taken 12 months, 12 weeks, more like 12 weeks. If they just really gave it their all and did what they were instructed to do from the get-go, then all it takes is screen time. Okay, but the hopping is a huge, huge danger. Now, granted, RAM works on all time frames, assuming you're trading it properly, you're recognizing the nuance properly, you're reading the context within reason, and there's enough data per bar, so not like a 1-second chart. I mean, right? We looked at a 1-second chart on stream the other day, not a good look. Here's what I think you'll find. Sometimes, let's say you're trading, let's just pull numbers out because I want to prove a point. Let's say you're trading a 15-minute chart. And, I lost 2 trades in a row. Oh my God, I lost 3, 4, 5 trades in a row. What am I going to do? And you hop over to, let's say, a 3-minute chart. And all of a sudden you win a trade. Right off the rip, you win the first trade you take. You've created effectively a fallacy. Okay, because what you'll really find over a large sample size is that if the market is operating a certain way, you're going to have similar problems more often than not going across 2 similar charts, like a 5-minute and a 2-minute. We're not going from a daily to a 1-minute, you know what I mean? Where that the ATR difference could really make a difference in how something performs. Now, when does it actually make sense, I think, to focus on something totally different as far as time frame? Well, if, for example, one time frame is not giving you anything for a short period of time of, weeks or months, again, you got to zoom out. Then, if a different time frame is actually cleaner, meaning each bar, for whatever reason, is just being represented in a cleaner fashion during that period of time, well then, sure, you can focus on a different time frame 100%. And I'm not like partial to any, I just like the balance of the 5-minute. I'm not married to the 5-minute chart. I could not care less. I'd trade a 2-minute chart. I'd trade a 15. I'd trade a 30-second chart if it were better for me. I don't care. Okay, it's just the 5 minutes a great balance. And what you'll find is that over a tiny little sample size, you might think that you figured, in this market environment, when I trade the 5, I lose massively. When I trade the 2, I make tons of money. It's not that extreme. If the market environment is the same, which of course it would be if you're making a transition intraday, and then you had the luxury of increasing the sample size, which you don't in a single day, I think you'd find that you'd have similar problems just more frequently on a 2-minute chart, since you're going to get more setups on a 2-minute chart. Now, there's a lot of nuance to this, man. I hope you're staying engaged. You better be staying engaged, all you guys. There's a ton of nuance here. And we're going to keep hammering it home until you can repeat it back to me in your sleep. All right? Part of the nuance here is that if it's like a follow-through issue, and you start looking at, because the market's going to move a certain amount of points in a certain amount of time, the same, regardless of what time frame you're looking at, right? I'm not saying per bar. I'm saying in like 20 minutes, the market's going to move because it's showing you the same data, right? Just represented on a different time frame. So if you go, let's say 2 weeks on a 5-minute chart, and you're like, oh my goodness, I'm having a really hard time with follow through. And then you check out a 2-minute, and let's say you spend an evening looking back through, and you're like, yeah, the 2-minute actually would have increased my edge because you're going for smaller targets because you're risking less because the ATR is smaller on the 2-minute, right? Then come the following week, it might be worth to put some more focus on the 2-minute as compared to the 5-minute. Assuming, nuance here, conditions didn't change the start of that following week. To sum this all up, everybody's really, really quick to jump around, grasp at straws. That's never the answer. Listen, guys, I wish it were the answer. I really do. I'm not, you're like, well, that's just not my personality. I want it to happen. Yeah, no shit. I wanted to make as much money overnight, right? It's not the answer to grasp at straws. I get it. Everything inside of you is like, yeah, but I have bills to pay, Nico. No shit. Don't we all? The answer, I love it, on a Friday night, baby. The answer is not to grasp at straws. The answer is to zoom out and look at things logically and say, hey, did I just happen to lose a few trades in a row? Or has it actually been a shift that I should look deeper into and spend an evening looking deeper into it? Trading, it's a job sometimes. Some days are great, man. You show up, you trade for 90 minutes, you make tons of money, and you go and have fun the rest of the day. That's the point. We're not here to work 18 hours a day every day for the rest of our lives. But sometimes, you got to do some work, right? That's why you get paid so much damn money. So, if you see this happening for 5 trading days, 10 trading days, it's worth taking a look in an evening and say, hey, is this a fallacy I'm creating in my head that I would do better on a different time frame? Because your brain is telling you, hey, it's not performing, you need to change something. When in all reality, every single, even massively profitable trading strategy is going to have periods where the market conditions, and it's going to overlap with a lot of strategies. When market conditions shift, volatility slows, breakouts fail at a higher rate than is typical in the market, a lot of strategies are going to struggle. Okay, but you have to understand that, if you've only been in the market for, 6 months, a year, 2 years, this happens a lot. And it usually doesn't last as long as everyone's fearful of it lasting. Okay, now sometimes, like summer 2025, low volatility environments last a whole season. But even in summer, it wasn't this big drastic shift. It was kind of just very similar price action day after day after day. And we adjusted very, very fast. Doesn't take much to make that adjustment. It's not even really we have to change this. It's like, oh no, we just end up doing more of this style, more of this bucket, maybe range scalps within RAM because we're not really getting a lot of continuation. It naturally shifts itself. That's the beauty of RAM. When you start with context, man, I really hope you guys are still following me here. When you start with context, the trickle-down effect This is not by accident, guys. The trickle-down effect keeps things simple. The adjustments happen automatically. I don't know where I was going with that word. Automatically. Okay, now again, there's still, periods where you might have to go in, manually make an adjustment, like we discussed just a few minutes ago. But when you start with context, you don't need to stress yourself out and give yourself high blood pressure thinking I need to change something because I lost two days in a row. You know what I mean? It's not, if the adjustment needs to occur more often than not, you starting with context, which is tier 1, the baseline of RAM, will trickle down and fix the rest of it, because rather than taking tons of continuation for the next 2 months, you just won't be able to assess it as a continuation context, and you'll end up taking more range scalps, which will be more appropriate for the context of the market because you started there. Okay, I really hope that makes sense. Question. They say I had a unique experience in a trade today. After a few minutes, I realized that I had misinterpreted the context, which may have invalidated the trade. In a situation like this, would it be wiser to exit the trade early or adhere to the original strategy and allow it to play out? This is a very, very good question. So, look, in order to answer this, let's go back and understand at the core of RAM, what does that tier system of priority look like? Kind of the top-down system. We always start with context. Number 1, before setup. Setup is tier 2. Okay, so I don't want this happening to you guys all the time, and I'll get into the nuance of this a little bit here. But if it ever happens to you where you enter a trade and you look back and all of a sudden 2 minutes later you're staring at it and something clicks and you're like, whoa, am I half asleep? I missed the context entirely. Well, you took the trade based on tier 2, which was setup, correct? And you missed tier 1, which invalidates, if it's wrong and it doesn't fit the context, it invalidates tier 2 because we start with tier 1. But you missed tier 1, so you skipped ahead to tier 2. In that case, I would argue that it's the best, wisest move to flatten the trade, whether it's break even, red or green, make an asterisk next to that trade, and move on with your life. Look for the next trade. However, this is the nuance of this because I know traders. I've worked with so many traders. I've seen so many traders' habits, as well as you're looking at them, or I guess you're listening to them. My own stuff, man, especially in those early years, I learned a lot about traders. And the interesting thing is all the stuff that I went through, I see in traders. We are not as different as you may think as far as the psychology behind all this, which is why I think a lot of you guys relate to what I say so often, or I guess so much pretty often, right? Because I've been there. Like we're all wired relatively similarly, and we all have the same issues, at least more or less, when it comes to the charts. Okay, it's very common to have those same issues, at least similar issues, right? So I know traders, and I gotta put a warning out there for you guys here in the tomb. What I just said, somebody is going to be in a trade and they're going to be nervous. And they're going to use, I missed the context as their excuse to close the trade early because it didn't go in 5 seconds or even 5 minutes. This is going to require, this is the more important part of this answer, by the way. This is 100% going to require you to be brutally honest with yourself. If you're missing context and you find yourself closing trades because, I missed the context, often, like even every week, this should not happen. And if you're doing this weekly or daily or multiple times a day, I think you're letting it slide into a bad habit where you're using that argument and you're lying to yourself to bail yourself out of trades that are making you uncomfortable, that are slightly going against you, that have you a little in the money, but they're not budging, that are sitting at break even, and you're bored. So you're like, I want to close it and move on to a different instrument. You took the trade for a reason, correct? Now look, all these problems, I shouldn't say all, this issue can be solved by constantly reminding yourself, okay, what's the context? What's the context? Reassess tier number 1 and then move on to tier 2, which is setup. Okay? Do not use this. You got to be honest with yourself. I'm putting this out there. Do not use this to bail yourself out and mask an underlying issue, which is discipline or patience issues. Okay, you guys know how I feel about this because it's so very important to maintaining an edge, a positive expected value, that I have to be brutal about this. Do not let this slide into, again, this shouldn't happen often, but do not let it slide into a bailout method to protect your emotions and avoid staring the discipline in the face because it's uncomfortable at first. I get it. Brute force it. It'll get easier. It doesn't take that long. 1 to 2 weeks, you'll have your brain relatively retrained, at least to a noticeable degree. Okay, we've talked about that so much as well. However, I will say yes. To answer the question, if it happens to once a quarter or once a year or something, even like once a month, it's like fine. Where, maybe you're having a little bit of an off day, you didn't sleep super well, but you still feel like you're okay to trade. You come in, you sit down, you stare at the charts, you take a couple trades, you're like, all right, cool. You take trade number 3, you stare at it. 90 seconds later, you look at it, you're like, oh my goodness, I completely, actually, genuinely, truthfully to myself, I completely missed that context. That's embarrassing. I would say the wisest thing to do, what I would do, is flatten that thing. If that was truly the case, and I was not lying to myself, I would flatten that thing, break even, red or green, make an asterisk next to it, and move on.